Welcome to the Economic Times Digital Payments Forum. Partnered with Mastercard, this initiative looks at how digitization and innovation will open the payments industry to new opportunities and push the country's financial inclusion drive. Thank you for joining us. Please extend a warm welcome to our eminent panel.
Hello and welcome. You're with the Economic Times and my name is Ashutosh Sinha. It's not every day that you have a topic to discuss that requires attention for the long term. Yet, it may be important, the topic that is, it may be important and does require serious deliberation even in the short term so that if needed, corrective measures can be taken or really smart measures can be taken. Today, it is the time to talk about financial inclusion. To be precise, it is about capacity building for financial inclusion. Welcome to Mastercard Presents the Economic Times Digital Payments Forum. So every business change that has happened in the recent month has had the context of the pandemic behind it. Now, the topic for financial inclusion may not have been impacted by the pandemic. It has been a serious issue in India for several years now, but at the same time, this is an opportunity that the industry has to drive financial inclusion. And hence, we're trying to understand some of the issues around the capacity building for financial inclusion. To talk about all the facets of it, I have a very stellar set of people with me. Dr. Deepak Mohanty, full-time member, Pension Fund Regulatory and Development Authority. Rahul Chari, he's co-founder and CTO at PhonePe. Lizzie Chapman, co-founder and CEO ZestMoney. Saurabh Chandra, he's managing director at ECG Platinion. And Nikhil Sahni, division president, South Asia and country corporate officer, India at Mastercard. Thank you so much, everyone, for being with us for this very important discussion, as I said it. Before we begin, I'd like to invite Saurabh Chandra for setting a context to it and giving us a broad picture of what are some of those key issues that are driving it, changing it, and what are some of those key issues that need to be kept in mind. Saurabh.
Thank you, Ashutosh. Very good afternoon to all of you who took their time out to participate in this reflection with this cohort today. Let me take a moment to just explain as what we are going to deliberate together today this afternoon. So this is such an important topic for the country and the world, which is financial inclusion. If we have to understand in a brief nugget as what financial inclusion means, first, it means that there has to be an availability and equality of opportunities to assess financial services. When we are assessing these financial services, what it means is that it talks about the products such as banking, loan, equity, and insurance products. And there are many more in many countries wherein several other way of giving credit, having the whole economy moving around. So such products pretty much are into the gamut of financial inclusion. The goal of financial inclusion is to remove all barriers, both supply side and demand side. Now, what does supply side means? So at supply side barrier, if you will think it through, and we all would have seen it in our day-to-day life, it is around poor financial infrastructure, if there is any in any country, lack of nearby financial institutions. I'm sure many in the country as well as outside would have walked miles just to take out that little bit of that money which has been deposited in the bank. High cost to opening accounts, as well as lots of problems in terms of documentations that has to be provided. So that is the supply side barriers. On the demand side barriers, it is largely around poor financial literacy. Many of us constitute the demand side of this particular subject. and to be knowledgeable in that particular area is important. Lack of financial capability, either pushed by culture, religious beliefs, etc. So these are barriers at the demand side. In fact, one quick trivia, if that can help us understand how important and big this particular case is, then worldwide in 2018, and we are in 2021-22 now, in 2018 itself, it was estimated that about 1.7 billion adults lacked having a bank account. So this is where the opportunity is. And if you think through it, few facts and country-wise, this will be something very interesting to understand, as where few of the countries in financial inclusion lies today. Philippines, they have 4 million unbanked Filipinos. However, they are getting benefited via the government scheme of credit scoring industry. Today, 4 out of 10 Filipinos saved money, which has gone up from 2 out of 10 in 2009. Among Filipino adults, 24.5% never saved, and only 31.3% saved today, which has gone up from 26.6% as how it was earlier. 26 million Filipinos, they are still living below poverty line. Now you can understand why financial inclusion is very important for us, for any country. Let's reflect back on few of our neighbors. Indonesia, 2016, there has been a national strategy for financial inclusion established. 2019, 76.19% of adult population, they have one or the other way of accessing financial instruments. And few of the levers, this is where government and various of the bodies come into play. They enable this inclusion. In Indonesia, they were National Council for FI. It was actually a program kicked off by the President of Indonesia. There are, government actually coordinates, synchronizes the implementation as how the money is flowing, whether it is going to the right hands or not. It unblocks implementation obstacles. It supports governors and the mayors in the respective regions where this financial inclusion policies need to be moved faster. Let's see a third case before we come to our own country, India, which is Tanzania. Population-wise, 55.57 mil. In 2006, 11% of Tanzanians access to a financial account, 11%, very less, very small. Today, just by the advent of digitization, it has gone up to 60%. So think about it, just in few years, how technology, digitization, fintech has actually spiraled the cause. And few of other things that government intervened and private players intervened were about mobile banking options, cards, internet technology. So if you can reflect back, we have few countries, but very disparate and fragmented landscape. Coming to India, and very interesting journey that we are having. If you will see, so, and we saw few of the countries, and now India, I'm sure many of us were waiting for few facts about financial inclusion in India. We actually were one of the front runners. In 1950, there was a scheme developed for financial inclusion. Between 50 to 60, there was nationalization of 14 commercial banks, branch expansion. 75, Government of India established RRBs. These are regional rural banks to meet demands of rural India. Early 2000 and 2004, there was a Khan Commission established by RBI to bring focus on financial inclusion. It couldn't have been just run in a fragmented way. In 2013, the government released a measurement index, which is known as CRISIL Inclusives, and therefore to measure as where we stand in financial inclusion. 2018, we actually were at 58 index point. If you see the scale of 100, we reached 58, which is pretty good in those terms. But in 2009, it was just 35.4. And again, in 2018, if you will see the account status, the deposit accounts stood at about 1646 mil, wherein the credit accounts were at 196 mil. So think about the CASA that is growing in the country, which is a good sign today. And it's a delight for many of us, wherein there is a village known Mangalam in Puducherry, and it's the first village wherein every household has banking facility. HP and Kerala declared 100% financial inclusion. Top 3 states for us, which has 100% or one of the maximum financial inclusions today, are Kerala, Karnataka, and AP. And by 2020, RBI vision is more, whatever accounts we are sitting at, 600 million more savings account to be created via several means, and IT and technology always takes the center seat. If you see this, if you have understood how financial inclusion has to be looked at and how countries are looking at it, how serious every country is, few of the levers that actually accentuates this particular inclusion for finance across the strata of society. Few of these instruments are stated here. I'll not go through all, but if you have to understand, there is a business correspondent model, which is launched in January 2006, which has been launched by RBI, which brings for-profit organization, NGOs, common service center in Gram Panchayats. UN has been very focused via certain programs. You are seeing a UN codes here, a DeFi, wherein fintech and technology is a very core focus by which the inclusion of various strata of society in finance can be brought in. There are unique credit cards. We in tier 1 may believe that there is just few of those denominations, but no, there are many that actually helps the tier 2, tier 3 and the village and the rural areas as well. EBT, number of rural banks, government policies, and government has played a very critical role. Narega, Pradhan Mantri Jan Dhan Yojana, and IBP, it is International Budget Partnership. It's a tracking agency that keeps all the government honest about the budget that every session has to demarcate for financial inclusion, and therefore various other reforms that government is picking up via policies of GDPR or by putting the platforms like UPI, NPCI credit scoring. So these are the levers by which financial inclusion actually starts growing in a country. With that context setting, let me open the floor and hand it over to Ashutosh.
Well, thanks so much. Big picture, and thanks indeed for putting that big picture in place, Saurabh. So that brings us to the discussion in that context and some of the other elements also we'll try and understand. Because of so much of talk and so much, I won't use the word hype, but so much of talk and the sheer reach of the fintech, I'd like Rahul to take this question. Rahul, the big picture, from the point of view of PhonePe, how are things changing? How are we trying to change the way things are shaping up, and so that ultimately we can build capacity, as the topic is, build capacity for financial inclusion, Rahul?
Thanks a lot, Ashutosh. Thank you, Saurabh, for setting that context so beautifully. And hello to everybody on the panel. Very excited to be here. So I think very specifically, let's take a look at from a payments lens, right? Financial inclusion is much bigger than just payments. But what payments has really done in the last few years, and when I talk about payments, I talk about the ecosystem as a whole, RBI as the regulator, NPCI as the organization that is spearheading UPI, the policymakers, the government, as well as the fintech ecosystem. I think what has happened is the usage of all the building blocks over the last few years in terms of the Jan Dhan accounts, which are the bank accounts that Saurabh spoke about as one of the levers towards financial inclusion, identity through Aadhaar, penetration of mobile internet in the country. Bringing these building blocks together, payments has been that one primitive use case that has accelerated digitization across the country. And when I talk about digitization for a country like India, where today we are realizing the benefits of our population as a population bonus in terms of the skilled workforce, in terms of the age of the population that's coming into the workforce, but also given the size, we need to be leapfrogging all the existing methodologies through which financial inclusion has happened worldwide. We just cannot be doing it the same way that it's happened in the past. And therefore, digitization goes a very long way in setting probably the foundational thing for everything that you would include in financial services, whether it is participation in a growing economy through investments, whether it is financial protection of one's future through insurance, or just in terms of participating in the formal banking ecosystem. Digitization is that foundational piece. Payments as a use case through UPI has transformed the country in terms of looking at the mobile phone and the mobile internet as the way to participate in this new age economy. And I think that is foundationally very, very important, something that we are all very proud of as an ecosystem as having enabled, right? Now, with that, the way we look at least from the lens of PhonePe, we look at now that a large part of the population, not just the metros, not just the tier 1, but tier 2 and beyond, are participating in retail payments at scale. The confidence and the learning curve to be able to actually get on board with a program that we call as financial inclusion has been significantly compressed. So trust, which is pretty much the basis on which you can take any of these financial services, especially to a population that requires a high level of hand-holding, is an all-time high through payments. The comfort level to be able to engage with platforms like PhonePe, to trust with your money, is now something that is there. The belief in the fact that convenience will always trump the warm and fuzzy feeling that you get by having a person hand-holding you through these has also been proven. Pure digital workflows, pure digital stories through the mobile phone and other platforms are seeing significant level of traction. So one of the most gratifying things for us is to see this young, semi-urban, semi-rural population being hungry to try out a lot of the products. So insurance is a classic example. Sachet-based insurance as an introduction to the world of insurance to somebody who's come on to digital payments platforms. Post that, kind of taking them through the right products like a term insurance, albeit of small value, but being the right product to go there. We believe that by actually leapfrogging the existing ecosystem of physical distribution of financial products through payments as the use case, you're able to take the right products to the right people at the right time. And I think that is transformational for the country. So we still have a long way to go in terms of streamlining a lot of the process and taking them further into the digital category. I'm pretty sure a lot of the other panelists, Lizzie would actually vouch for KYC processes, sharing of KYC between regular entities, etc. But the foundation has been laid. The population is hungry to try out stuff, and we have the opportunity to make sure that the right products reach the right people.
Okay, that's pretty comprehensive as well, because we touch payments, we touch insurance, and a whole lot more. So Lizzie, since another fintech there, and I'd like to bring you in. The landscape we have an idea of. Can you explain the depth where it goes? Because in a country like India, there's also the challenge of languages. There's a challenge of changes in regional, the way it's consumed or the way consumers approach it in different regions. What has been your experience and how have you gone about it?
Yes, thank you so much, Ashutosh, and thank you, Rahul, as well, for brilliant opening remarks. I think you've set the scene perfectly. This is a topic that's extremely true to our heart at ZestMoney. We obviously moved our lives to India to build a business in the space of democratizing access to credit for exactly the reasons we've outlined here. We see one of the biggest opportunities in the world right now, but one of the greatest levels of complexity. And I love one point Rahul made, which I think follows on to this question. What worked in other markets may or may not work here. We have to find our own path. And India is such a heterogeneous, complex demographic pool that we mustn't assume that copy-paste models from Western markets will work. You're absolutely right. We do recognize that the diversity is part of the complexity. And this has been one of the barriers to true financial inclusion from the traditional consumer credit perspective, which is the area we know best. I will talk mostly on that because that's what we understand. Banks typically have struggled with last mile unsecured consumer credit distribution for exactly the reasons you outlined. Far too much complexity, far too much diversion in things like the languages, behaviors, income, affordability. Just look at the GDP per capita from state to state. We have 8x differentials, right? Which means completely different calibration models in any form of underwriting. But to highlight the points that have come out so far and why we are so optimistic about the future and the impact that we can make in this space, what we do have in terms of capacity creation is some of the best infrastructure in the world for new credit delivery. Now, what am I talking about? We obviously operated in Europe. We came from Europe. We worked in a company that operated in 8 markets all over the world, including North America, Europe, Africa. India, even 7 years ago, was by far the most advanced in the way that policymakers were thinking about financial inclusion and laying the rails of a level playing field of infrastructure. What we've seen in the last 3 years is beyond anything we could have dreamt of. We have seen an absolute acceleration in the creation of that infrastructure, and not just the technical aspects, right? We all know the promise of something like account aggregator, right? Everybody, I think, here appreciates account aggregator unlocks the consumer's data and basically enables anybody in the country to submit and share their data with a credit provider who could use that data in underwriting. This is a game-changing, globally impactful product. So we're saying the technology is very powerful, but what's even more exciting about this market is the policy that goes alongside that infrastructure is very, very favorable for the development of financial inclusion. I'll just leave on one example, which is this account aggregator, but I hope we have time to go deeper into it. But not just is a great piece of middleware being built, what's coming with that is an entire policy change around the way we view customer data in this country. There is a very clear layer of consent architecture, which is implying forcefully, which we appreciate, that the consumer owns their data and the consumer must be informed when they share their data with a third-party provider, and that they must be given the incentives and the reasons for sharing that data. This is a very, very powerful policy change. And combined with the data protection privacy bill that we believe will be coming in the next table, we see an incredible opportunity to make not just the provision of unsecured consumer credit to the last mile easier, but to do it in a much more sustainable, long-term and consumer-centric way, which you haven't seen in many, many other markets, where there would be, monopolistic private companies having access to the customer's data, which later are difficult to break down. So that's just one point I think is really important. When we look at the infrastructure, the technology, let's look at it in the context of the policy that comes alongside that, combined with what that does to encourage private risk capital to come and put money to work and create that capacity utilization.
Okay, now that's an exciting change that's happening, the account aggregator, and the process is pretty much on as we speak from the banking regulator. Dr. Mohanty, from your part, so in your role at RBI, so I'll try not to get into that part right now, but I guess at some stage you'll have to draw upon that. But right now, from the Pension Fund Regulatory Authority point of view, what are some of those key long-term steps that are going to change the way financial inclusion happens for the long term as well? Because pension ultimately helps you build a future, a secure financial future.
Thank you, Ashutosh. I think when we talk about financial inclusion, essentially it would mean a bouquet of products. You start with payments. We have done substantial progress on that side in collaboration with fintech and credit. Then you get into insurance and pension. But when we talk about pension, the penetration relatively is quite low. So there is a long way to go. And here, if you see that broad estimates would suggest that 22% of our population have access to some form of social security, which would include pension. And the bigger one, those who are in the organized sector, would be the provident fund that we have, and there are different kinds of provident funds, all that put together. And if you look at the assets under management, it could be about 16% of GDP, not a big number. Compare that with the global kind of an average that you will see advanced country, it's more than 100% of GDP. So that itself would suggest that there is a long way to go. And where do you come in as regulator here? Because there are two products that we regulate here, and we are responsible for that. Is NPS, National Payment System, and the Atal Pension Yojana. That's more for the low income unorganized sector. And here you see that it's about 3.5% of the population covered with these two schemes. And the asset under management is about around 3.4, similar number. And but the growth is quite good. That if you see that enrollment, that what is happening, largely driven by Atal Pension Yojana, that is APY, is around 25% per year. And the corpus that we've been managing is growing at the rate of about 30%. But there is tremendous scope in this sector. And pension is the last thing in people's mind. If you talk to youngsters, immediately anybody switches up or not now. And when we start realizing that maybe in your 40s or early 50s, then it's too late, because then your accumulation period is very less. So then you see it's too late. So also it's for insurance. When some adversity strikes, you think, oh gosh, I would have had an insurance. So then what you need, a little bit of a nudge is required in this, because the payoffs are not immediate, and you need the knowledge. The literacy is also required. I've been all my life in the financial sector, but to tell you, I may claim of some financial literacy, but I didn't have a pension literacy because I never applied my mind to the whole process. But these are two good products are there, and we are taking a number of steps to bring in people into that. So it needs intervention at multiple levels. Basically the intermediaries are the banks. So we have set targets with them, and then outreach both by the banks and from our side, doing all kinds of literacy for different stakeholders in the whole process. And so it should progress from here.
Okay, Nikhil, in terms of the building blocks, and I think Rahul mentioned about it, the building blocks for what could be the infrastructure as it is being built. How could that change the way, something like pension, which Dr. Mohanty mentioned, which reaches a larger percentage of the population? You mentioned just about 3.5%. So, Nikhil, what do we really need to do so that this can be scaled up at the scale that India needs it?
Thanks, Ashutosh, and good afternoon to everyone, and very interesting comments. So, I think what has happened is, as Rahul, Saurabh articulated this. I think one of the most significant things that has happened over the last 10 years to the payments industry in India is that we were always constrained by distribution. So organizations such as the one that Lizzie comes from and the one Rahul comes from have enabled in distribution, because distribution is no more a constraint. The second thing that has come up is the technology has become something which is now the order of the day, and it's something which is developing so regularly over a period in time. And distribution and technology together have created a platform which allows reaching the last mile much easier. Now, just look at some of these numbers. Now, as of end of September of 2021, the overall retail credit in the Indian banking system, which for the first time crossed the wholesale credit in the Indian banking system, was 29.1 trillion rupees. The sorts of platforms that Lizzie runs, look at a large base of customers and do a small ticket, buy now pay later loan, and just think about the amount of retail credit you can create. Now, that is step one, to create retail credit. And typically the problem of taking the sector forward in the Indian system has been that banks typically are really puzzled and crazy about a word called NPA. So you want money, you want to lend money, but you want to get it back the easiest way, which is what data is enabling. Organizations such as Rahul's, who have and as well as Lizzie's, who've put these building blocks together so that you have data. What the government has done is, and Mr. Mohanty has been one of those who've enabled policy, through policy, this distribution and all of this to be created. So today the government of India runs significant number of DBT schemes. Okay, how exactly money is going to flow into an account. There was mention of MG and Rega in Saurabh's presentation, right? Don't we know those patterns? We know those patterns. Can we create loans around that or not? We can. Can organizations today look at 1,000 rupee, 2,000 rupee, 3,000 rupee, 5,000 rupee loans, which can be for a short period of time? Yes. So from an infrastructure perspective, I think we have all of it. From a data perspective, we just need to put these building blocks together. There's nothing great about these ideas. All of this is fairly well documented, fairly well understood. When Mr. Mohanty was talking about pensions, I'm like, shocked, 22% of the population, only 22% of the population has some form of social security. What country are we living in? We talk about 1 billion Indians, and this is what we have. So, but I look at the 78% as an opportunity. And whatever I'm telling you, these are, so a mason, let's say in a tier 3 town in India, requiring a 10,000 rupee personal loan to, have better capability to serve a wide variety of customers. And if he has some sort of access to a DBT scheme from the state or the central government, we know those patterns, plot those patterns, lend, get the money back. You have systems and processes today. UPI allows you to do that. You're allowed push and pull payments today in the system. We have developed all this infrastructure. So I think from an infrastructure capacity building perspective, what we have done over the last 7 years is simply outstanding. I think we just need to put the building blocks together. The third thing that I'd put together is, I think from the perspective of truly digitizing the Indian economy, there is fantastic distribution that has gotten created through JAM, through Jan Dhan accounts, unbelievable distribution capability. People in tier 6 towns have debit cards. So great. But how are we actually ensuring that we are running truly digital? So you have a debit card ultimately with the last mile. If you're still, withdrawing money out of a business correspondent or of an ATM, you ultimately are getting cash back into the system, right? So how do you kill that? By creating more acceptance. Rahul's organization does that wonderfully well. But I'll just quote an example on the opportunity size and what I was just about a couple of days back in Guwahati. Ashutosh, I and you had a chat then. I went to Kamakhya Devi temple, which is like a fairly well-known, temple in Guwahati. Not even a single methodology or way of paying, through a card or through a QR in the entire temple. I donated about 5,000 rupees with my friend. Now, just look at every point in time in the temple, I could see people dole out cash, to donate. And I was just kind of trying to think through. And all of this cash, if you bring it into the ecosystem, I think we don't We don't need anything in terms of capital. Capital anyways, Lizzie and Rahul will tell you is not a constraint in this market at all.
Okay, that's very interesting because I'm aware quite a few, some temples definitely in that sense you referred to it, Nikhil. Some temples do follow, they have some kind of digital payment options, but then ultimately boils down to execution. Rahul, you wanted to make a point, please.
Just wanted to highlight a couple of points that Nikhil mentioned. Very, very pertinent, right? One is acceptance. I mean, the fact is that retail payment and acceptance for retail payment, which is the final node in the turn of money, if you look at the economy, we are on a tear, right? We've reached 25 million merchants. We're going to rural right now. We're taking larger goals. So are the companies. But he made a very pertinent point, which was that doesn't necessarily solve the turn of money digitally completely, which means smaller businesses, when they are buying from a wholesaler, who's buying from a distributor, who's buying from a super distributor, the digital economy does not extend all the way down to the node. And to try and digitize every turn of money in the economy, I think would be a huge, huge step towards financial inclusion, because at that point, the need to really cash out, because once you do cash out, the cost of money actually increases significantly for whoever the person is there. And that brings its own set of troubles, right? So I think that one point, extremely important. The other one is, again, data. I mean, we are all sitting on a pile of data, the account aggregators coming about, but DBT being a classic example of government data, companies like us sitting on transactional data of retail payments, opportunities to actually combine the power of data to actually ensure that we are enabling each other's businesses versus trying to create silos of businesses will also go a very long way in terms of opening up or creating financial inclusion. And I think the policies there are evolving. They may need to evolve a little faster, but we are big proponents of trying to actually use open data, because I think innovation will win on the merit of the products and the experiences that you create, but data needs to open up much faster for us to actually accelerate the vision towards financial inclusion.
Okay. So since Rahul, you mentioned about that, and Saurabh, in your initial presentation, you also mentioned about some of the cultural issues. Could this, tier 3 or tier 4 cities converting that cash back into the digital forms, could that be a cultural issue, also accentuated because of the cost that it involves? Saurabh.
Yes, if I take a reflection and largely across countries, the way money is consumed or distributed by various entities, either individually or via industry. One of the very important nuance is the cultural fabric of that particular country or place. Several of the places, there are connotation around when to put the first cash, when to take out cash, how to conserve cash, whether should it be conserved in the form of cash or credit or instrument. So there's lots of cultural nuances involved, and our country may not be very different. And this actually brings the complexity to a larger scale, because we are multi-country within a country. If we take out north, south, east, and west, and all four enjoys such a thriving culture that in few parts, not keeping money in the bank is more safe than keeping money in the bank. In few, not keeping money as cash, but to put it as a gold is more sacred. In few places, there is this whole societal fabric of putting the money in the bank, but with an instrument of non-risk taking liabilities. So culture certainly plays a very strong part, and religious beliefs, that was secondary. So both come together, brings the complexities to a different galore. And that is where the opportunities as well.
Okay, it just makes me think, Nikhil, because since you went to the Kamakya temple, and Lizzie will just mention, Kamakya is one of the places that any person, they will want to go and visit. So I wonder, Nikhil, if you're going to do next time is, do some UPI with 101 rupees. There's a sacred element to that 101 rupees. So you're going to transfer by UPI, is it? Do you think that will happen?
No, I think that's, I think you've given Rahul an idea. And I'm sure it'll be picked up quickly and delivered. I completely agree with you. There are these concepts that we as a market have created, and they're fundamentally ingrained in our cultural systems and cultural values. So I don't think a sell to a customer is the issue. I think fundamentally, from whatever we have created and the cultural differences will always stay, but they can also be enablers, which you can utilize. So I know of villages which kind of adopted digital inclusion because somewhere in the scheme of things they felt that would bring the entire setup together in a much nicer fashion. So to that extent, my opinion remains that I think culturally we are right up there. There is a lot of opportunity. Kamakya Devi is one example. You look at some of the other larger shrine boards that exist in the country. Absolutely amazing. The only idea is get this capital in and ensure that it moves. I think at this point in time, one of the things that is becoming a bit of a dampener is that this capital never gets to see the light of the day. That's the fundamental issue. And to the point that we were discussing with Rahul earlier, on acceptance, I think that is possibly where the maximum focus, at least if I were, looking at this side, I think I'd be looking at acceptance as a point of view.
Okay, Rahul has raised a hand. I wonder if he's already ready to launch something.
Well, on the point of cultural and religious is a separate topic and is slightly more difficult, but it's also not as big a problem. Culturally, I believe that convenience always trumps practices, rituals that are more cultural and are frankly outdated. And there will be forcing functions. The pandemic, as unfortunate as it was, has been a forcing function to change behavior and overcome any cultural barriers that any part of the country may have had, right? UPI, if you take the demographic, right, from an 18-year-old who's just about ready to actually transact to the 80 years old who are actually using mobile phones to transact across every PIN code in the country at scale, is a great example and proves the point that convenience will always trump any sort of inertia or cultural practices that could be barriers. And I think it extends well beyond payments, because the ability to actually simplify pension is really tough. It requires a fair amount of education. But on the back of the distribution that payments has created, and on the back of distributing the right products, simplified products, low cost products, you build that building blocks in the journey of the consumer to take them to the pinnacle, which would be pension, which could be term insurance that are of correct value, etc. So I think convenience will always trump any sort of cultural barriers that we may have.
Okay, Nikhil, you wanted to come in.
I think Rahul said what I specifically wanted to point out on how, and the pandemic has been a classic example where, there has been so much of adoption of digital technology. And one of the most significant things I think which has happened, and this is something that will unleash itself over the next 5 years, which we don't realize, so for example, we were born with newspapers. And, given the situation of the pandemic, maybe there was not as much, people are not as comfortable reading newspapers. And suddenly you figure out that you've been reading online so often that after things started to become normal after the second wave, you suddenly figured out that you didn't need a newspaper. Kids at home are these days getting access to digital payments from a very, very different perspective. You will soon realize the way they are looking at digital payments, and this is not only happening in large towns in India, this is happening across the board. So, you might look at a situation over the next 5 to 6 years where this will completely get unleashed. because people will only want to transact on the mobile online and nothing else. So it's a great change. It's not exactly a cultural change. It's a cultural change, not from the heterogeneous society that we stay in, that from that perspective. But this is something which is going to bind all together and become a change which you will see unleash something over the next 5 years, is my view.
Okay, so among all the change, or among such cultural nuances and the breaking down of cultural nuances, Lizzie, whatever you've seen or noticed across India, what has caught your attention the most?
So actually, it's funny. I almost often disappoint and say the opposite. Humans are surprisingly similar all over the world, and that's one of the wonderful things about lending. You learn very quickly how humans behave in all sorts of scenarios. Like humans need incentives and motivations to do things. There's a tried and tested carrot or stick for every behavior. We raise children the same all over the world with the same mentality. So in lending, we find that the same tricks kind of work. I think what's really important is education, and we haven't talked about that enough today, but that's something we are absolutely fanatical about. And in any sort of emerging consumer credit industry, we believe it's absolutely vital and critical for the players to consciously take responsibility for that education. We've operated in markets where that didn't happen. It cannot be left to regulators or governments. It must be something that the industry itself co-creates and pioneers, and it must be done because it's the only sustainable way to create a healthy industry that's in the long run actually unit economic viable. The best way to prevent excessive credit losses is to have very high quality financial education. The moratorium is a great example. We actually diverted literally millions of dollars and half our team just to educating customers about how to handle the moratorium, which we didn't see a lot of other brands doing. And in the end, we had extremely low loss rates. And I think that's a testament to how powerful that education was. So I do appeal to the rest of the industry. We have set up as digital lenders, the Digital Lending Association, where we focus heavily on education of the consumer, of the ecosystem, but also we have created our own code of conduct to create some best practices amongst players that we believe even existing regulations won't always cover because things are moving so fast in digital. So, for example, we saw a very predatory practice emerging last year where some app-based lenders would scrape the contact list of a borrower who's in their collections practices. We have self-mandated as the Digital Lending Association. We as our members will never follow that practice, for example. So I think that's really, really important. These are the types of things, they're not necessarily cultural nuances, but these are important learnings of what we must do to create, the safest and healthiest industry from a consumer perspective. But there's one final point I just wanted to pick up that Nikhil mentioned a couple of times. I'm going to take issue with, seeing as we're now getting into a bit of a jousting. He said capital is aplenty at the moment, and that's not the issue. But I disagree. I think that risk capital is still a big challenge, actually, in this space. I think the new influx of capital we're seeing from global investors, particularly hedge funds, is not going towards financial inclusion, to be very honest. It is going towards some of the infrastructure that we've been talking about, but typically they don't like credit risk and some of the complexities that we're talking about now to do with literacy and education. That type of capital isn't flooding into the space. And at the same time, we do not have enough domestic high risk capital in the form of NBFC type capital that needs to be deployed. So I think that's an area where we could see a little bit more policy shift towards making it easier to attract risk capital. So I'll just give a simple example, but the securitization norms that we have currently in the market are relatively prohibitive to fast velocity securitization. In the rest of the world, securitization is much, much easier. And that has been a big lever in growing, in financial inclusion and kind of acceptance of consumer credit. So I do think there are some things we could do, again, as an industry, to get some shift in policy towards a slightly more free, high velocity risk capital market within limits. I don't think anyone wants to see the financial crisis, the famous Lehman-esque shenanigans in this country, but we are still relatively prohibitive in the way that we look at debt capital markets and things like securitization, and that would be a big boost to financial inclusion.
So, okay, take your point there, Lizzie. Dr. Mohanty, then, as we now see distribution, as the experts here are saying, distribution is pretty sorted. Technology, we are pretty much sorted again, and we are at the forefront for that. Regulation, the regulator has been largely, and I'm talking of RBI for a moment here. So from the regulation point of view, we pretty much enabling environment there. What more would you like to see done so that the capacity building part that we're talking about, that can be a game changer for tomorrow?
Ashutosh, if I may, just on the previous discussion on the payment side, because cash vis-a-vis digital, as was rightly put by Saurabh, that there is a supply side to it, there is a demand side to it. For one, I would believe that it's more of a supply issue, because you have to have the acceptance infrastructure. Here, friends from the fintech are taking less credit than they deserve, because if the supply infrastructure in bank base is much more costlier compared to the way that the fintech companies have really enabled, the payments company that to have a supply infrastructure. And you'll agree, all of us are doing more digital payment than earlier, and that's true of all strata of the society. Well, earlier, one could never think of paying the household help with digital payment. And you go to street food for a small amount, also digital mode, because there is the infrastructure, there is the QR code. Here, regulation also has helped, because the interoperability which is brought in. Otherwise, earlier it was a proprietary QR code that somebody else really could not do that. And there are also barriers from the banking side, because as ours is a bank-led financial inclusion process, because everything ultimately linked to the bank account, UPI coming, interoperability happening. So these are the regulatory enablements that's what has come. So I'm pretty sure if with religious places, if it is there, many of us, rather than carrying lots of currency notes, can always pay through the digital process. As rightly was said, that you don't get a 1 rupee currency note that easily now. So, but you can always donate to the God, 101 rupee or 1001 rupee what you have. So all this acceleration which has happened is that the changes in the regulatory space and the thinking. Earlier, that apprehension was there, because that is an interface between the fintech companies and the banks. Then they say, there is always the risk of contamination. Those kind of things were there, because the banks not only not only handling retail payment, they're also handling a very large scale payment. So always there is kind of a risk. But with regulatory enablement, this is really happening. And partly it's all accelerated by the unfortunate COVID pandemic that we had. At least it has given a push to the way the regulator really think. I could give an example of eKYC. It's a video KYC. Earlier it was unthinkable. And interoperability of KYC. For example, in the pension space, that somebody comes earlier, we would require a separate KYC to be done. But now that is not required. You have a bank account, you just bump it up the bank, and then the confirmation comes, then your KYC is done. We don't ask for a separate KYC. And digital onboarding, because there's the eNPS, is completely costless and takes about 10 minutes. You don't have to go. If somebody is tech savvy, sits down on the desk, can easily do that. KYC is also done. You have an e-sign. You have OTP-based authentication. Then you are indeed through. So these are the enablements which have been brought in by the regulator. Since on the broader issue of regulation, since it is a financial space which is a regulated business, so it would again depend that what is the kind of collaboration really comes in, and what is really allowed within the regulatory space. What I'm referring to is credit. That's there as Rahul said that there's so much of information going on in the system. Are we really harnessing that information for payments, credit, and other things, which can certainly be done? And so there need for a regulatory thinking that how do you enable that whole process, that the information which is there, how we best harness to further the cause of financing. That's what I would.
Okay. So Nikhil, in terms of now for the next level for industry and policymakers to work together, the regulator, of course, because ultimately the regulators, push ahead and enablement is so important. What all needs to be done so that we take this to the next level?
I think as far as I'm concerned, there is a fair bit that has already happened. I think it's more about scalability. I think I take points on the credit side, but as I said, there will have to be a beginning that is made somewhere. So one of the things that has started to happen, of course, is that India has about 900 million debit card holders and roughly about 60 million credit card holders. And fundamentally, this debit proliferation has happened after the Jan Dhan movement, kind of somewhere in the scheme of things was launched by the Honorable Prime Minister. So give and take, you'll have, let's say, about 600 odd, or at least 650 to 700 million unique debit card holders, and maybe about 35 to 40 million unique credit card holders. So use the debit card platform to kind of create credit suitability and create credit products, smaller, short-term, high frequency, low risk, sort of products where you have you have mechanisms that are able to, figure out how exactly the payments would happen. According to me, that's one way of taking the credit market to the next level, because see, fundamentally, India was always if you go 25 years back, we were quite credit averse. Today, there is interest towards the credit side. Yes, we are worried about creating more bubbles ultimately from the credit side, and which is where I think the regulator also tends to be a little careful, rightfully so. I don't see anything wrong with kind of settling things up so that. But yes, I think the debit card portfolio that is available across banks is a very good, and the transaction flow and the transaction pattern can very easily give you a sense of how you can create more and more revolver credits, going on the backing of such a debit play. And I think how can these be enabled? RBI recently came out with guidelines on what they wanted to happen on the digital lending side, and some of those are still under observation, just trying to see how exactly we could. So I think enablement on the securitization side, well, whilst I don't have a specific point on securitization, but at least one policy initiative that I remember, which was launched recently, I think it might be about 9 months old, is when the regulator allowed co-lending along with NBFCs for banks, because from the priority sector lending perspective, and some of these small ticket loans and so priority sector lending is typically misunderstood only as agri lending, but there is a fair bit on that side that can be kind of built in, and I think from a policy perspective, that's something on the lending side specifically. So I think these would be a couple of interventions which I at least think. So one could be from the side of the financial institutions and banks, and the other would be on the policy side to try and see how we can fine tune some of these initiatives to ensure that we reach the last mile, with a credit product a little faster.
Rahul, the same question to you. In the context of taking it deep inside India, maybe tier 4, tier 5 cities, and build a culture or build a product where it's micro lending and where you can, the predictability of it not turning bad is fairly high.
Yeah. One, I'd like to give a big +1 to the points that Lizzie made. I think education and investing as an ecosystem in educating the broader base on financial services and not just payments, a very, very big need. Another very important point that she touched upon is the practices that the ecosystem through technology and how they operate need to be, I wouldn't say necessarily, they have to be regulated, obviously, But the caution of how we take this and scale it and the ethical side of thing is also very, very important. Like she touched upon that, how ZestMoney goes about their lending practices, which should be best in class. You need to actually ensure that the industry is like that. Because if there is any sort of mis-selling, today it happens in the physical world, it is still significantly smaller because of the fact that the reach is extremely curtailed. Now, if the same sort of mis-selling, if it happens through technology at scale, you have a much, much larger problem, whether it's lending, whether it's investments, whether it is insurance. So I think what technology brings about as a positive, which is high scale and high reach, the flip side of that, it needs to ensure that it is kosher all along the way, right? And that's extremely important. And therefore, all of us need to actually take that into consideration and invest quite a bit in holding each other accountable and not just the regulator actually holding all of us accountable. Now, to your point, in terms of taking this deep with lending, I think we've come a long way in terms of the building blocks. Like Sir mentioned, in terms of eKYC now being allowed for everything from account opening to actually doing the KYC for lending, we need to also take a view of scalability to some of those processes. Like today, an eKYC for an account opening with an IPV through video still requires that the person doing the IPV be a live person and a full-time employee of the company, that is, whether it's the BC or it is a regulated fintech. That really isn't scalable for our population, especially when it comes down to things like payments or even micro lending. To be able to start experimenting with technology by pushing the boundaries in terms of liveliness checks, using computer visioning, and to be able to use data much more effectively to make risk calls, I think is a very, very important need of the hour. Microfinancing up to a certain amount can actually work on a different principle of KYC than lending that is of much larger amount. So using data to make calculated risk-based calls for scalability and reach is extremely important. What that will do is it will actually accelerate the microfinancing lending in India. And through that, through the cycles of that acceleration is where you will get the data to actually improve on the scores for the new to credit market. I think what we are currently battling is trying to control the NPAs for a NTC market without the ability to actually generate enough of risk-based loans to accelerate that learning. So I think some of those calls have to be made to be able to actually ensure that one, risk capital is available. Two, risk capital is being deployed at a slightly faster rate with kind of the policy that allows for that scalability, and then bringing the controls to actually bring the NPAs at an acceptable level.
Saurabh, since the issue was raised, also wanted to talk about some of the concerns, for the industry: mis-selling, security, data privacy. How is that being addressed? And we're talking in the context of, as it was raised earlier, also the India's data privacy laws being round the corner.
Yeah, so it's my response will be that if it is a bad news, it's a good news as well. Good news primarily because there's so much happening, but obvious when there's lots of levers on finance, which largely is enjoyed by the society, is played, then there will be certain checks and balances that comes into play. And that is where a little bit of these fraudulent activities or discussion on data privacy or the benchmarking around the whole collection or distribution that the discussion is happening. So all these lead to certain policy measures that one has to take into account. Now let's understand this very practically, taking our country into account. We have 4 different distributor set that largely enjoys the capital market today. One is the big boys, which are known as banks. The second is subordinates, which are known as NBFCs. Two more have taken birth in the last 7 years. One is fintech, which says that I'm going to sit on top of the bank, will help you distribute your money or channelize your money in the rightful way. And the fourth is a subcategory of the product portfolios of the bank, maybe in certain case payments, in certain case credit cards, in certain case lending, in certain case collections. So we have grown. We actually have grown, and largely because market is seeing us as a need to grow. Now, because of that and technology being in the center of this growth, information security, which is PII, your payment data, your data around between country movement, as many of the players as how ZestMoney is operating here, as well as may have planned for other countries, likewise many others. Regulatories are finding it but obviously difficult, as how we all would have found it. And therefore, there is a policy iteration that is happening, wherein you would see that though we may not have an ideal GDPR policy, but then there is a policy. Are we so strict on GDPR as how few of the other countries are? Maybe not. And largely because we take a view of the widespread population and the opportunity that we sit at. So therefore, policy says in certain dimension to practice this business. Likewise, on PII, there is a definitive definition in certain part of the world. If somebody breaches it, the whole entity can be pulled down. In our case, it is not so. And therefore, there is an iteration of policy. So, and the third is, which is at our side, I think Rahul, Nikhil, Liz, all three said, self-regulation. I believe that no industry can thrive until and unless it is highly self-regulated. In this, my personal viewpoint is that we need to point a finger on ourselves at times, that how secure we have kept the whole consortium of data or the details of my consumer. I think there is a big opportunity as well. So if you see, it's a dichotomy between a policy by the government, self-regulation by us as an industry and entity. And the third dimension is the needs of the customer, which are growing or giving birth to the new industries. Balancing these three is the talk of the town.
Okay, that's very comprehensive there, Saurabh. Dr. Mohanty, since you are a regulator, may I seek your comment on the issue around one, security, and the other, the privacy of data that's so important as we move ahead towards building that capacity?
In the broader context of, as you see in case of bank, because this is something that investment really happens at the backdrop, and these are regulatory entities. You can really see what they're doing with the information, what they could do, what they cannot do. And there is also a reporting mechanism, because as you know, it has strong spillover negative effect in terms of, in the payment system, one gets impacted. You will try to hide it under the carpet, but it's going to impact the entire financial system, and the financial stability gets impaired in the whole process. So given that scenario, because I think it's the fintech sector, so I think have to be more invested in case of cyber security on this aspect that I think. And so coupled with grievance redressal. See, ultimately what really matters in case of finance is confidence. And confidence could be fragile, not only that in an emerging market like ours or developing country like ours, but we have seen globally also, what triggered the global financial crisis. So that confidence has to be given. So then there has to be a robust, grievance redressal mechanism that has to be put in place that will have confidence. And as you know, RBI has moved in this direction, because the entity they're regulating. So now there's a consolidated ombudsman scheme. And you can apply. You don't have to pick up a particular email or something like that or number to do it. It could be across entities. And that also entertains, because as you know, because the financial sector is also getting interlinked. It is not within the regulatory domain of a particular regulator. It will be taking payments, it will be pension, it will be insurance. So it cuts across a regulator. So that one really should accept. And it is for the regulator to figure it out, who is the lead regulator, who should be looking at it. So that distribution mechanism, here again, technology is key, because manually this was not possible. So those kind of a mechanism that we would have to provide, obviously, that once we do that, with the fintech, and then it gets much more distributed. Even the companies will not know that at the front line, at the grassroots, what really is happening. So we need to have a mechanism so people have confidence. So that calls for investment on that side, and some bit of good practices that need to publish that there's kind of a risk. But that kind of a balance that one really would have to maintain. That's what I would think.
Okay, so not really a heavy hand. I like the word, and the way you've clarified, Dr. Mohanty, not really always a heavy hand that works. Nikhil, one last question to you before I ask for a summing up from all the esteemed panelists here. How can, as technology and the digital initiatives, drive scale and also be a bridge between retail investors, financial advisors, and all the institutions that are involved, so that it also drives inclusion in a big way?
I think, for that, I'll take a specific example of MSMEs and how exactly, the sector. So I think there is a very, very strong case for, building supply chain related, efficiencies into the entire MSME ecosystem. As you're aware, 63 million MSMEs in India, just about, GST registration is not even 10% of that number. So, that is one classic example wherein it's a sector which is partially digitized. It's a sector which can understand much better in case digitization is of a larger order, and classic case of a lot of investment that will flow into it, because if you do supply chain linked financing, which with the bank at one end, with the corporate anchor at the other, and somewhere you are able to fund the entire chain, because the challenge typically in the MSME segment is that the long tail never gets financed, and that is something which which once included can really create a very, very significant credit scope in the market as well. And because you have an anchor at the center of it, you also can control the risk that is associated with this, which will build in more, so it's again an entire supply chain. It's retail, it's MSME, it's corporate. So it's anchored supply chain that is a classic example where you can digitize the entire ecosystem, you can enable digitization. We've tried to do it with certain pockets. We've also done a line of credit with USAID and DFC, along with HDFC Bank, to $200 million line, which will specifically work on digitizing, the entire ecosystem, rather than, being only, a small set of borrowers. And this sort of a program specifically can create, it creates credit book. It creates, I won't say completely, by definition, it's not a secured credit book, but it's got strong connects within the supply chain to be able to be built. It creates more interest in the entire credit ecosystem. I know of fintechs which are doing this job really well and scaling up really, really fast, looking at the right kind of anchors. So it brings in investment, it brings in, the risk capital as well as the appetite. So this is one classic example, at least, that I would want to talk about in terms of how it can happen with MSMEs.
Okay. Lizzie, in terms of the appetite, there is market, there's no doubt there is enough appetite, but industry needs to go about it the right way, even if there's a lot of aggression. Give us a sense of what you see maybe 2 or 3 years down the line.
No, I think you've summarized it brilliantly, Ashutosh. I think we are so optimistic, excited, positive about the potential for the industry, but we really, really believe that nothing beautiful can happen overnight, and we need some patience and we need some thoughtfulness into the way that we think about policy, the way that we work with regulators as an industry, and we make sure that we walk before we can run, because there is something very, very crucial at stake, which is the trust and faith of a lot of consumers who are coming into an industry for the first time. So I think you've hit the nail on the head. I think we are, especially as the Digital Lending Association, we've always been absolutely pragmatic about how fast we can realistically grow this industry, but that we must do it with a conscience and a collaboration, bringing on board the entire stakeholders, from regulators, government, and especially, as we've talked about in the last few minutes, bringing in banks to make sure that fintech bank collaboration plays out to its natural conclusion. The fintech should be bringing the distribution, as we've talked about, building the railroads, bringing that access point. But the banks ultimately need to bring the capital and the sort of, the regulatory standing that makes the whole thing work together. So collaboration would probably be my biggest takeaway from today.
Wow, that's a wonderful word to hear, collaboration, Rahul. As one of the pioneers in the industry, how do you see the next year or two, and what steps would you want the industry as a whole to focus on?
I think collaboration is key. I've always been maintaining that fintechs are really technology players combining with the financial institutions, traditional or new, to be able to actually take financial services to the masses. So I think collaboration is extremely important. Over the near term, which is over the next 2 years, I think the industry needs to come together with the regulator as well as policymakers to look at all the processes that need to actually be rethought in this new world of at-scale distribution through technology to actually achieve the end goal in the shortest possible manner. Because there is an opportunity to accelerate our path towards financial inclusion. There is an opportunity to try and accumulate the data and the learnings in a compressed time frame so that we can actually achieve that vision. But everything from KYC, from sharing of KYC across regulated entities, sharing of data, using data towards risk-based calls, whether it is for KYC, whether it is for lending, whether it is for collections, etc. I think there is a need to look at the processes and to say that how can we use the technology and scale it much faster.
And Saurabh, since you mentioned about the global number of the people where that number, I mean, it was almost like 20% of the world population. And while in India we have covered some of that through JAM and the way it has evolved, how do we drive it to the next level? And given the opportunity that the mobile phones there, the Aadhaar's there, and the bank accounts, because of mobile, are there as well.
Yeah, and very good question indeed. And I see that, in fact, it's already happening. And I see it in 3 dimensions that it's happening. One is very critical role government plays in this activity. If you would see a difference between few of these instruments and Jan Dhan, was that Jan Dhan was made mandatory. There was a reflection of quarter-on-quarter numbers that were being tracked and questioned. So one, from the actor, which is government, how they are enabling many of the banks. As you know that even banks have personas. There is a big bank, there is a small bank, there is a regional bank. So there is lots that from government and the policy side, which is happening in terms of enabling the ease of banking in various of these segments. So that is one. The second is the literacy education of consumer around their money. What is that they own? What is that they can demand? What is that they are authorized for? So there are lots of NGOs. There's lots of activity at Gram Panchayat level. And I'm not talking tier 1 and largely tier 1.5, because we all pretty much are handy with internet and newspapers to learn about it. But in the rural sector, there's lots of activities at Gram Panchayat level, at Chaupals level, and with NGOs, the education that is happening. So that's at the society side of awareness. And the third is enabling the third party ecosystem, wherein payments fintechs are coming, loan fintechs are coming, collection fintechs are coming. And if you can see, policies do not restrict them. Yes, it may be a little bit difficult because we are dealing with money, but in many countries, you know, it's not so easy to start up a payment business or a business dealing with money. And here it is relatively easier when you see various other parts of the world, especially with such a big economy opportunity that we sit at. So these three levers primarily are going to be disruptive for the country in a good way.
Okay. So I'm sure as one of the regulators, and I keep harping on that, Dr. Mohanty, you will look forward to these changes, particularly because of the past where, you know, at the RBI, what you did, some of the work that you did regarding financial inclusion. What has been your dream to see? And since you were so passionate about this subject, if you can take a couple of minutes to talk about that.
Essentially, I believe that we are at an inflection point in terms of finance and financial inclusion, and on the access that we are providing. So it is not only access, but a convenient access. So that's again because of technology. And another thing that, you know, data has become affordable. So kind of disruption we had in the telecom sector. So that has been generally good in terms of data availability at affordable cost. And finance is also empowering. Today, the common person also thinks without any money or with a small amount, can partake in the formal financial system. So that is the other thing has happened. And the other thing on the regulatory setup, also that silo mentality has also gone. Maybe mentality is a strong word, but the silo concept is also gone. And it was spoken about the national strategy for financial inclusion. So all regulators are part of that. Then who should do what? So that's there. And we have the strategy for financial inclusion for 2019 to 24. I am sure that this is kind of a rolling strategy and gets updated depending on the achievement by all the regulators. And similarly, that you see that we have also floated a National Center for Financial Education. That is by all regulators. So then this is again recognizing the cross-cutting nature of the whole process of finance. So all these are enabling clauses. And also, if you see, the regulator also has shown great flexibility to accept the whole thing. For example, you see the BC model itself. Now the BC is identified as a banking outlet because you have 600,000 BCs in the villages now. There are 640,000 urban BCs which are there. So that is the way to really go. And on the pension space that you would see now, an individual also can really sell an NPS. That's the kind of enablement that we have brought in, and not micromanaging the whole process. Then we say it is for the bank. So we also desist from giving very detailed guidelines on that side. So that flexibility also has come. So that should help. So what needs to be done is essentially to expand the usage, that we are on the right direction, that you see that, okay, you have access, but how to use, because given our levels of per capita income, I'm saying lower strata of the society. And from the government side, you see the direct cash transfer, the initiative which is there. So that itself also going to speed up usage, because if you see the usage parameters, so we are quite relatively low compared to many other countries, and I believe that's really going to explode. And then what we need to do is education. I think financial education is very important. scope for mis-selling on many things are very less, because if you look at insurance, I'm talking of the inclusion again in the low income households, because you have insurance, PMJJBY. So, kind of life insurance you have, there's no scope in selling. APY, which is a government guaranteed product. So it's not a differentiated product. So there is no, question of mis-selling there. And NPS is a highly regulated product. Possibility of mis-selling is very less, but the knowledge is not there. Would you believe that in a scheme like APY, the annual return is almost like double digit? It's since inception, it's 9.98. So you don't even take it as a pension because it's as a savings product. It can also be used, but the lack of knowledge on that side. Knowledge, I would think, not only of the consumer, but also the intermediaries, particularly the frontline staff of the bank. We presume they understand. Perhaps that understanding, as I said, my understanding was also not that good, where I didn't apply my mind. And so that has to really need to be improved. And also knowledge of the BCs and these agents. So they should do. And so we need to invest on that side. And so that is a focus that one would have to give. That's what I would think.
Sure. So Nikhil, few years later, should we have more smiling people in tier 3, tier 4, tier 5 towns when they interact with their banking correspondents or with one of the financial services providers, because they will be better, hopefully better informed?
So, okay, let me try and answer this question in a format that you like, not test cricket, but one day international format.
Okay.
We're chasing 350 or 50 overs, and we are maybe about 150 for 2 and 20. So we're doing well, but the fact of the matter is you don't have enough wickets in hand. Or let me put it, it's 150 for 4 and 20 overs. So we don't have enough wickets in hand. But the target at large does not seem to be that daunting. So what I would, kind of put it in perspective is, yes, I think we should be getting there. The chances of getting there are fairly good. But at the same time, I think we will need to consistently keep on innovating. I think there was a point made around education. I think that will possibly be the most critical cog to, kind of get this going. I completely appreciate comments on insurance, but it's as Mr. Mohanty was also saying, a product which is not as well understood and very, very prone to, getting it wrong. So I think, yes, you should have many more smiling faces as far as the tier 3 and tier 4, kind of cities are concerned. I would also take it to tier 6. But I think consistent innovation as well as constant dialogue, we'll have to just hone and fine tune, policy as we move along. And I think we should get there.
Okay, wonderful parallel that you've drawn with cricket. Thank you indeed, Nikhil, for that input. Thank you all, everyone, for being with us on this very important conversation, because ultimately this is about the way India will be tomorrow. And this thought, these ideas, they help shape the India of tomorrow. Thank you so much for being with us.